For most of this year, the big discussion point in the markets has been about interest rate rises. We've been focused on how far rates will go and when they'll be high enough. The US Federal Reserve, which then led to other central banks as well, have made their statement loud and clear that we can expect rates to be high for a long time. Basically the reverse of the forward guidance that they found to be quite effective after the financial crisis, when they said the opposite, that rates would be low for a long time, and then they allow the markets to do the rest of the work for them. But now chatter is turning more and more to rate cuts. The markets are starting to price in cuts for early next year, and we're seeing more investment banks including it in their forecasts for next year in these end-of-year reports that they all release, which are notoriously inaccurate and never particularly worth the huge number of pages they're written on, but still quite interesting anyway. Like last week, economists at Deutsche Bank came out with their prediction that they expect 175 basis points in cuts from the Federal Reserve next year. They said, we see the economy hitting a soft patch in the first half of the year that results in a more aggressive cutting profile starting in mid-year. So basically they're expecting some sort of recession. And other analysts have said some similar things. Some are expecting more of a soft landing, but pretty much everyone's expecting there to be some rate cuts next year. I think that's quite likely. But for now at least, there seems to be some positive signs in the data that the US may be able to avoid a recession. Advanced real GDP came in at almost 5% for Q3 this year, which was the strongest reading in 2 years. And at the same time, CPI inflation has fallen to 3.2% from a peak of nearly 9% last year. There are a few big howevers here though. Firstly, interest rates remain relatively high until those cuts start coming in, and even then they'll still be quite high for a while. And these hikes, these interest rate hikes that we've had over the past year, can take some time to filter through to the economy. So it is possible that all of these rate hikes from this past year still haven't filtered completely through yet, and it could lead to weakness going forward from here. And this weakness is something we may be starting to see in the labour market. In October, the unemployment rate increased from 3.4% to 3.9%, which means that we're kind of seeing a mix of conflicting signals. Now, we obviously have the NFP non-farm payroll released this Friday, this week, and the trend is expected to be in a similar sort of direction to what we've seen recently. The headline figure is going to be trending down, it's expected to, likely below 200k, and it would have to be a crazy strong number to put rate hikes back on the table for this year. I think it's pretty much out of the question for another rate hike in December. Now, as we've discussed in many videos on this channel, there are many different indicators that can be used to predict recessions. But to be honest, they're all a bit questionable in their own unique ways, like they all have pros and cons. But one that's become particularly popular in the last few years is the Sahm Rule. Now, you may remember that we did an explainer video on the Duomo channel a few years ago about the Sahm Rule, and you're probably going to see this term, the Sahm Rule, appearing more in the financial media over the coming weeks and months. You may have already seen it recently. Now, unlike the other methods like inverted yield curves and things like that, the Sahm Rule is meant to be able to predict a recession much sooner, almost immediately. Now, it isn't perfect. It has on occasion been late by 3 months, but this is a significant improvement still over alternative methods that are used by the NBER that can be delayed by 6 months to 2 years. The Sahm Rule was developed in October 2019 by Claudia Sahm, a former Fed economist, and it basically signals the possible start of a recession when the 3-month moving average of the unemployment rate rises by at least 0.5 percentage points above the low from any point in the previous 12 months. So based on the jump up in unemployment to 3.9% that we saw in October's report, the Sahm Rule increased to 0.33. Now that's not that far from the 0.5 threshold which signals a recession. According to Claudia Sahm, 3 months at 4% unemployment would signal a recession. However, this may actually be one of the times where the Sahm Rule isn't as reliable as it's been in the past. In a recent interview with the FT, Claudia Sahm said, "Just because it works in the past to signal early in a recession does not mean that it will necessarily work this time, because all kinds of empirical regularities have broken down in the post-pandemic recovery." One of the concerns that was raised about the Sahm Rule during this cycle, and it's a valid one, is that we had a big drop in the labour force right as the pandemic started, and it's been a very slow recovery. We've seen the labour force participation rates come up, and that can be a good reason for the unemployment rate to go up as more people come in and have trouble getting jobs. The reverse is true too. It could be that the earlier 3.5% unemployment rate may not have been telling us the same thing that 3.5% would have told us in the past. Rebalancing is not and has not been a linear process. Remember, we've had these swings that make things look like they were going really well, and then it shifted to concern about a recession. So we could get into a period where we have, in this rebalancing, a temporary period of weakness. The reason the story of the Sahm Rule breaking without a recession has any credibility is the fact that we've had such a disrupted economy since the pandemic, and the disruptions are not gone, and we have deeply misjudged how long it would take to unwind them. According to some, the rule would be broken if it hits the 0.5 threshold without a broad-based contraction. That would be consistent with unemployment hitting 4% for 3 months. And this is what the Federal Reserve policymakers are forecasting: unemployment to hit 4% and remain around that level without a recession. Now, the link between unemployment, economic growth, and inflation is an important one. If unemployment rises, even in the face of a strong economy, that should lead to less demand for labour and slower wage growth. Now, based on comments from major central banks during the inflation crisis beginning in 2021, including the Federal Reserve and the Bank of England, they were concerned that a low unemployment rate, particularly with high job vacancies, would lead to built-in inflation. So built-in inflation is something that I've explained in a video a bit earlier this year. It's when people are expecting inflation to rise, or they're seeing inflation rising, and they demand higher wages in line with inflation so that they don't end up taking a pay cut in real terms. So this can also happen through job hopping. Since unemployment has been low and job vacancies are high, then you can have the same effect from job hopping. As a result of this, not only do people have more money to spend in the economy, which can lead to more inflation, but also businesses then have to increase their prices to make up for the higher costs that they're facing from wages. And of course, there are higher costs everywhere anyway. So it starts to create this spiral, the wage price spiral. Now, built-in inflation is pretty much the worst case scenario for central banks, and it's often called sticky inflation because it can be very persistent, very difficult to tackle. Now, you may remember that central banks often use the phrase that wage growth is inconsistent with the inflation target. So this meant that wages were too high to achieve their inflation target, which is typically 2% for major central banks. So what this means for the current situation is that if we're seeing increasing unemployment levels and slowing inflation, it could allow the Federal Reserve to achieve their ultimate goal of a soft landing. We've got higher unemployment leading to lower labour demand, lower wages, alongside slowing inflation from other areas, helping to control inflation expectations, which then reduces the risk of sticky inflationary pressures. So it may be the case that the economy doesn't need to go into a recession to fix the inflation problem after all, as long as the labour market isn't too tight and inflation continues to fall. So basically, all of this will give the Federal Reserve more reason to hold interest rates at current levels rather than hiking further, as everyone already expects they are going to do. And if a recession does look more likely, that could fuel market expectations even more that rate cuts will come sooner rather than later. And so this is kind of explaining the current situation. And as I mentioned, with NFP on Friday, unless it's a spectacularly huge number that completely beats expectations, I think rate hikes for this year are off the table. And now we can start switching our focus to when the rate cuts will start to come in. But as always, let me know your thoughts in the comment section down below. I'd love to know your point of view. And thank you very much for watching. Take care.